Thank you for joining us once again here at Seaford and Brew for our economic briefing. For this briefing, we want to look at the third release of that GDP for the second quarter. And we can see there wasn't much of a change between the second release and the third release. Overall GDP growth remained at that 2.3%. There were, however, some little adjustments in the individual components that made up that growth, but nothing too elaborate, nothing too out of the ordinary. When we look at the growth rate of GDP going back over history, we can see our current time of expansion. On average, the growth rate has been 2.3%. Now we are in the longest expansion. We're at 122 months right now. The prior record was 120 months back in the 90s with that dot-com era. Now look at that growth rate we saw in that time period. That average growth rate was 3.6%. So while we've been in this expansionary period for the longest of history, we are growing at a relatively low level. Now we take that and we see where the Fed expects our GDP growth rate to be over the next several years, and we can see that in 2019 the Fed's looking at a 2.2% GDP growth, and then working its way down to a 1.8% out in 2022. So we see this not only continual slow growth, but a reduction in growth throughout this time period. Now when we look at the IMF, they also are projecting out a slower growth in GDP for the United States. They have the 2019 at 2.6 and then the 2020 at 1.9%. So we have two bodies here made up of highly educated and smart individuals that are expecting the growth rate in the United States to continue to be low and then also to go lower. And not only here in the United States, but we also see that expectation at many of the other developing countries. As far as inflation goes, this third release showed inflation on the core basis increasing by 1.9%, higher than anticipated, and that could weigh in a little bit on what the Fed's going to do in their October meeting. But we're still below that target range of inflation at that 2%. Looking at the expectations for inflation with the five-year forward inflation rate, you can see we continue to move down in that expectation. So showing just this continual low level of inflation, and that would for us point to a continual low level in that 10-year Treasury. As for that Fed funds rate, we saw the dot plot that came out from their most recent meeting, and we have 5 individuals that are projecting the Fed funds rate to be at that 1.75 to 2% range at the end of the year. And then that's flanked by 5 individuals expecting a higher level of Fed funds and 7 individuals with 1 more rate cut. And so they're building in that third rate cut for 2019. The question is, when will that rate cut occur? If we look at the implied probabilities put out by the CME group, we can see there's a 53% chance that that rate cut will happen in October. However, we're under the camp where if it's going to happen, I believe it will happen in that December. I think with the 1.9% inflation number that just came out and some of the other economic statistics that have been coming out, I don't see the need to lower that Fed funds rate by 25 basis points in October. That's why we're pushing that out to the end of the year. However, there could be some negative economic news that could sway us to move into that October timeframe. But when we're looking at that and we look at that volatility of that 10-year Treasury, we see it coming down. It got down below 1.5% for a few days, and then it popped back up and currently in the 160s. Now, think about how this overall interest rate environment is going to impact not only those loans on your balance sheet, but also those deposits and the expectation of depositors in terms of the rates they will be receiving over the next year. We do have an opportunity now to reduce down those CD specials that we've had out there, and then also consider pulling back on those core cash type deposits, those money market and savings accounts that we have. That's going to be the bigger play as we move forward. Our expectation, because of this low level of inflation and the slow growth in GDP, we're anticipating that that 10-year Treasury will continue to move down. So we're seeing it being flat to the downward rates over the next 12 to 18 months. So take that in consideration when you start working on your budget for 2020, how that's all going to work through and impact the overall yields on your assets and the cost of your deposits. That's what we have for you today. We look forward to talking to you in the future. Have a great day, everyone.